just do a brief introduction of the firm, who we are, kind of why we set the firm up the way we have. Energy Finance Partners is the best way we explain it. A fundless financial sponsor focused on the upstream oil and gas industry, really deconstructing the traditional in caps and Riverstone type models where we feel blind pool private equity has run into a lot of headwinds for both investors and the operating partners that make those companies and those firms a lot of money and great returns. So I'm really trying to put the value and the upside back in the hands of the value creators. This is our core thesis. Samina and I came to start working together about a decade ago, really with a common vision around this again direct investment platform. In doing so, we felt we needed to develop a valuation solution. Lower 48 is a SaaS cloud-based analytics and portfolio evaluation platform that we developed alongside of EFB. I'll let Samina tell you a little bit more about that. We're both former Wall Street veterans, working for big banks and asset managers over many years, and having been born and raised in Texas, I really wanted to move back and focus on the upstream business with lots of friends and participants across the spectrum. From the guys that founded some of these private equity firms to the geologists, engineers, et cetera, that sort of revolutionized our oil and gas industry here in the States. I'm kind of flying a little blind here, I think. But just share, where am I go? You just share screen. Is that what I do here, guys? Okay. Here we go. Up. Okay. Samina, are you on?
Yes, I am. Yes, I'm.
Oh, there you go. Okay. I think she's on as me. Actually, she's logged into my link. So, Samina, say hello if you would, and I'm gonna. I'll actually drive the deck and let you introduce yourself and walk a little bit further through the strategy. We've got about 20 minutes, so we'll be somewhat brief. Won't go too much into the structure. At the end, we can talk a little bit about that offline and take questions. So, Samina, I'm going to let you introduce yourself, and I'll drive the deck here.
Hi, great. Thanks, everybody. I'm Greg and I are partners in Energy Finance Partners, and we are focused on finding differentiated opportunities with high cash-on-cash returns around the upstream space. Our efforts are facilitated by the fact that there's a real capital dearth, or capital gap in that space, and traditionally it's a market that has well-established structures for putting in direct investments at the operating level, basically bypassing the corporate structure of the actual operator. So without further ado, the working interest opportunity we're going to present is low risk, high upside in a favorable macroeconomic space in upstream oil and gas. As we always do at EFP, we try to find an experienced management team that can execute on the specific concept. In this particular case, we're using Perpetual Production as our partner in this, and we'll tell you a little bit more about them as we go. We will be duplicating, I guess, the structure that we've already used to offer tax-efficient access to overseas investors, as well as U.S. investors, for this particular space. So if we can go to the next slide, Greg. So why now? Well, we've got an partial exodus of significant financial players from the space for political and ideological reasons. ESG investing, although there's some pushback, has been widely adopted by large pensions, insurance companies, and asset managers. And part of that, the ESG thesis, is to be against carbon-based industries. We believe that that the U.S. obviously cannot afford a transition, nor can the world. We think that a robust oil and gas sector is in our vital national interest, and in continuing to support the industrialization. And also we have, by accessing our own resources, we also eliminate the need to import from less congenial sources. So if we go to the next slide. I just want to remind ourselves, what are the value steps in upstream investment? Um, at the leading edge, if you will, you have a land grab mentality where the operators figure out either where resources are, or in the case of the shale revolution, not where the resources are, but how to get them out of the rock cost effectively. That was a technological revolution that has been fundamental, really, to our economy. Early on, that was that prove out the technology, lease out the rock, demonstrate that you can get the stuff out of the rock. That is a high spend on balance sheet exercise, which is best financed with private equity. It was financed with debt, which was a mistake, but being that as it may, that's sort of in the rear. Now, I'm hearing a bit of an echo. I hope nobody else is.
I think it went away.
Okay, good. So then, but then once you've, once as an operator or a team or an ecosystem of operators, once they've leased up the rock, done the drilling to convert their packages of assets into proved reserves, you then have the step of development drilling. That is the highest return and quickest return of capital in the upstream life cycle. If you think about a portfolio of upstream assets valued on a net present value basis, the cash flows that I'm going to get out of this, and how I discount it to the present, putting the drill bit in the ground essentially reduces your risk and also your implicit discount rate, and correspondingly gives you an immediate step up in value. That's why we call it the steepest value creation uplift. The cash returns from drilling are in months, not years. As I'm sure many of you know, the oil wells tend to produce on a high initial and then decreasing basis with a long tail. Your capital outlay and your capital return is front loaded, and as you go through this as an operator, the drilled and producing wells that you are creating are the lifeblood of your asset class. Now, if one could put sort of a little box around that and look at a portfolio of wells 48 months out from their drilling, you now have a diversified cash flowing portfolio with a proved profile that may be around for 20, 30 years. And that portfolio is separately monetizable, financeable, and in fact, there have been securitizations against that part of the space. We're playing in this middle, high quick return part of the life cycle. So if we go to the next, to remind ourselves, well, what are we buying here? What we're buying, we're developing a portfolio of something called non-operated working interests. Now, working interest is a direct investment in the drilling and operation of an oil and gas well or a portfolio of oil and gas wells. So as a working interest owner, you share in the ongoing cost of drilling, operating, and producing the well, and get a proportionate share of all the profits. Now, the investment in non-operated working interests is a common U.S. structure. It's been around for 100 years. And non-operated working interest owners range from individual investors to large upstream companies who have partnered to develop select fields in the lower 48, continental U.S. And we'll talk a little bit more about that because that's the direct source of this opportunity. So on the next slide, we put out a sort of a schematic of what is the value stack of a flowing barrel. So visually, this we're using $100 oil, but that helps you to sort of gauge the percentages. So what happens when a barrel of oil comes out of the ground? Well, the first thing you have to do, of course, is to pay your severance and ad valorem taxes. In this case, it's modeled, sort of on a state of Texas. So $8 goes to the state of Texas. You also have to pay the production cost, which may be, $6. And if you put in any allocated corporate overhead, you're up to $10.50. Now, the other thing you have to pay, actually, before you pay yourself back for production costs, you have to pay a royalty to the minerals owner. So Mr. Rancher, or whoever you leased the land from to drill, gets a fixed percentage of each barrel that comes out of the ground. If you're familiar with investment in minerals and royalties, that's where you play as a royalty owner. Now, if you do all this, there's an EBITDA. The working interest owner paid to drill the well and now shares in a percentage of the EBITDA. So that's where the working interest owner plays. So then, now, how did this come about, or rather, why is this opportunity of a scale that's interesting? Now, historically being 25 years ago, when the shale revolution started, actually more like 15 years ago, what you had was in places, especially like Permian, you had places where there's been drilling for quite a long time, lots of vertical wells. Everybody sort of knew what was inside the rock, and operators started exploring the horizontal drilling and fracking to prove that you could get the oil and gas that is tight within the rock. Now, I'm sorry. Am I? Is everyone hearing me all right?
Yeah, we hear you.
Okay, sorry. There's some background noise. Great. Okay, so now in that first phase of sort of proving that you could do things, large, sophisticated operators felt they were diversifying risk by taking cross holdings in each other's leases. So Cimarex might be developing a lease over here, and EOG would come in and say, I'll take 10% non-op working interest, and the Cimarex would say, well, I'll take 10% non-op next door, EOG, where you're operating. This way we're diversifying our risk. We're not making a concentrated geography bet. Now, fast forward to today, nobody believes there's any risk. So you've got this mosaic of cross holdings that was established when people were more interested in geographic diversification before the fields were fully delineated. And now, so you might say, so what? If I'm EOG and I own 10% of a Cimarex project, that's good for me. However, against that, you have a development that all of these sophisticated upstream, especially public companies, have been telling their capital providers, I'm in full control of my capital plans. I know exactly what I'm going to do. Every year, I've got a disciplined plan of how I'm going to operate. And by the way, I'm going to be spending a lot of money, returning capital to you. So there's no reason EOG should be paying special dividends of, $5 a share per year, but they're doing it because they're demonstrating that they're in control. Now, the one thing none of these operators is in control of is when does the other guy decide to drill? So the non-op rights, although they're very attractive, represent an uncontrollable, quote unquote, capital commitment on the point of the non-operated partners. Now, you might say, if I have a non-op interest in a well or in a set of wells with a 60% drilling IRR, I should be happy. However, in this environment, non-ops would prefer to monetize their non-operated working interest positions rather than walk away from them and leave that potential return on the table. And that's where we come in. So next, if you go to the next slide. Okay, so again, we talked about how this came about, but in terms of the technicalities of the scale, if you look at sort of 2023 kind of drilling calendar in the US of almost $8 billion, and if you cuff a 10% average non-operated working interest, we're looking at an $8 billion opportunity set. And we don't going to go down over time. So, so just very simply, there's a drilling opportunity. As a non-op, I could say I go non-consent. The operator says, "Go with God. I'll pay for your side of your share of it, and I will pay myself back 2 times my investment before I send you a dime." The non-op would like to have a third party, such as ourselves, come in, buy the right to participate in those wells, so they get something for it up front, and then we put those wells into our portfolio, creating a diversified high return portfolio. So if we go to the next slide, we again, same, this is from the Energy Information Administration. As you can see, tight oil, which is oil that's really accessed by horizontal drilling and fracking, is going to be the lion's share of oil extracted in the US for the foreseeable future. And that's, again, that's where we play. So next slide, please. So all this gives us an opportunity to build a diversified asset level investment portfolio where we are enjoying the services of high quality operators in tier 1 acreage. We have this all built up from single well economics, which build up into a compelling corporate level return and very short payback periods for drilling and completion. The legal framework for direct non-op working interest participation is time tested. It's been around for 100 years. And then on top of that, we have a great deal of tax efficiency for both US investors and overseas investors. And we bring to the party an experienced leadership team with a proven track record and a great backlog of deal flow, which we'll go into. So how do we find the opportunity? Our friends at Perpetual have deep and differentiated relationships with major upstream companies to access their non-op AFEs in tier 1 basins. Now, these opportunities come in on a daily basis. They come in through a combination of strong in-basin relationships with the operators and the brokers, and also with sometimes as simple as an email listserv that goes out to potential interested buyers. The trick is to be prompt and disciplined in your financial bids. You have days, not months, to respond, because the individual AFEs are in a very tight time frame. Now, the sellers will keep going back to Perpetual if they're getting correctly priced capital offers, and then Perpetual integrates the funded AFEs into the investment portfolio with best-in-class closing processes, which again are time-tested, well-known, but you have to execute on it. So the next slide. So then we structure appropriate investment vehicles in order to take advantage of this opportunity. We have there's a proven tax efficiency both for U.S. taxable investors and U.S. non-taxable and overseas investors. We can offer asset level transparency down to, we don't insist that investors look down to the individual well, but they can if they like, via Lower 48 Analytics, which is a best-in-class SaaS upstream portfolio management system. And we have proven service providers that we have used to execute on these structures, including SS&C, Weaver and Tidwell, Mourant Tauzin, Curtis Mallet, Prevost, etc. So next slide, please. So on the tax side, the taxable U.S. investors are going to be LPs in our AFE portfolio. Our overseas investors are going to come in through a U.S. corporate blocker that we've developed and executed on. Both the LP structure and the blocker benefit additionally on a tax timing, from a tax timing point of view, from the fact that the underlying activity, i.e. drilling oil wells, benefits from a favorable tax treatment for intangible drilling costs. Those are immediately expensable against current income, and 80 to 85% of the drilling and completion costs of an oil well are in fact intangible. So those tax timing differences can be quite attractive. So if we go to the next slide, just a reminder of our investment process. This is a continual, this is a sort of a continual cycle. We price new AFE offers, or we'll price them daily. We purchase and fund them. We monitor the cash flows against our projections, and then we monetize the investment portfolio because there is a ready bid for groups of producing wells with a certain vintage, if you will. And that's something that we so ongoing thing. So now for the next slide. Now we're going to take you through a little bit of a more granular example of how we're actually doing this. So the first thing is we maintain a backlog that's updated daily, and each one of these lines is an AFE. By the way, an AFE is authorization for expenditure. It's the notice that a non-op gets from the operator saying, so if you look at the top line, EOG has sent Conoco a notice saying, I am drilling a steamboat 347, whatever, in the Maori Formation. If you go over to the right a bit, you see the that's in County, Wyoming. This is I'm spending $9.8 million. You've got 4% share in this, so you can send me $404,000 if you want to maintain your share. And so each one of these separate opportunity, which we analyze, we model, and the product of that is we might go to EOG and say, we might go to Conoco and say, okay, we'll pay you $100,000 to step into your shoes, or we might say, we can't afford to pay you more than $10,000 to step into your shoes, so we'll probably pass on this one. So so each one of these opportunities is separately priced and negotiated by us. This is where our advantage comes in our ability to be systematic and prompt. So now if we go to the next page, what we did, this gives you a little more insight into that. So we might look at an individual well and conclude, wow, if we could just, step into this opportunity, this is a 60% IRR. Now, the non-op holder is not going to gift us that opportunity, so we're going to have to pay him something to go away. So what we did for purposes of this illustration is we assumed that we could walk in and pay the buyer, pay the seller a normalized payment, which will normalize the return on that particular well to 22 to 30% IRR. And we triage, of course, to only bid on things where there's we think we know with a fair degree of certainty what the drilling returns will be. And then to create this portfolio, we also budgeted a cost overrun cushion of 10% for drilling and completion costs. Now, every operator loves to boast how he's in control and is continually bending down his cost curve. So we're aligned with them. However, we do build in this cushion for purposes of generating our bids. So then next slide. So what we did is to create this illustration. We went in, we looked at the actual backlog that was available, and we observed that once we go through our exercise, our triage backlog is concentrated in the Permian Basin, with a little bit in the Bakken, some in the Anadarko. By the way, parenthetically, we're seeing a lot of opportunities now in the DJ Basin in Colorado more recently, and that's and then so then in this particular portfolio, we pay on balance 35% of the AFPs to the non-ops way, and our expected portfolio IRR is 28%, assuming cost overruns, approximately 33% if all the AFPs come in at budgeted costs. So going to the next slide. Just visually, this is what our cash flows look like before fund fees and expenses. You see up front, the silver is the drilling and completion costs. The blue is what we assumed we had to pay the non-op away, and we have our overrun there in orange. And then, as you can see, the returns come in; those are quarterly. payments start coming in very quickly, because wells produce very quickly after they're drilled. And within 30 months, we have a return of capital. We have a 28% IRR. This is before fund fees and expenses. And we have a monetizable tail that we'll talk about in a minute. So then now one thing from a risk view is the following. When we look at what we expect to make on each individual well, one of the things we have to project is commodity prices. And what we like about this strategy is that since we're paying money when the drill bit's about to go into the ground, and since the production is front-end loaded, the most of the risk from a commodity point of view is in the near months. So in other words, we're not betting on what oil prices are going to do 20 years from now. We're actually, most of the cash flows we're buying are priced off the front part of the curve. And that is actually quite important. So and we will be very transparent with investors as to the production profile and if we choose to hedge. Now, just very quickly, because we don't want to spend a lot of time on this picture, but just so you understand how it works, here, this is our structural schematic. So what we have is we've got a portfolio of non-operated working interests. The GP is a joint venture between EFP and Perpetual. The U.S. investors come in as LPs in this portfolio. That's very standard. And then for our overseas investors, one of the partners, one of the LPs in the non-op portfolio is actually a U.S. corporation that won't spend the brain damage on this call, but basically funds itself with debt and equity placed in the Cayman Islands. The debt and the equity are ultimately owned by the same Cayman Islands entity, so there's no leverage per se, but that structure allows payments to go offshore with no backup withholding and tax sheltered to the extent that a large proportion of the payments is respected as portfolio interest on a loan.
Samina, real quick, I think we're running into
okay, right. So we'll skip this for a minute, and if we go to the onshore, which is probably of more interest to investors here, we are focusing on the payout metrics of the investment. Again, to remind ourselves, we have, because of the drilling of the tax shelter, the early payments to investors are completely tax-free. Once we run out of that shelter, we start having to pay taxes. That's the green thing, and then at the distribution at the end is a liquidating distribution that is actually, given the structure, not highly taxable. So what does this do? Well, it gives us an IRR, a pre-tax IRR in the 22 to 26% range for our onshore investors, with tax timing benefits that might be useful in other constructs. And so that's and just very quickly, if you go one back, again, if you happen to be offshore, again, you've got a highly efficient with deferred tax paying reality if you're an offshore investor from a tax haven jurisdiction. Okay, so that's basically that. I think we have some track record material in the presentation. If we can just skip to the
actually, I think we're running up against a time crunch here. Okay. I want to summarize real quick. Basically, what we've done is gone out and found an execution partner to aggregate these wellbores and give our investors a diversified, multi-basin, multi-operator portfolio versus betting on that company or backing one play, if you will. I think it's the most efficient way for investors to take upstream oil and gas exposure, as we've said, and really focused on delivering to our operating partners the kind of infrastructure and financial architecture they would get from a private equity firm, giving more value to them and delivering more value to our investors by eliminating the fees associated with blind pool private equity. Jameen and I have a pretty storied background, lengthy background in investment banking, structured finance space. So we really, we think we complement our operating partners very well. We'd love to answer a few questions, and I'm here today, tomorrow, and we'll be in New York as well. Anybody have any questions?
Yeah. So how long has your fund been operating for, and how many actual investments do you have now?
Did you hear that question, Sabine?
Yeah, no, this is a new fund that we're launching. We have deployed the same structure and the same concept in a minerals fund that if we can skip to the very end, we can show you a track record on that. So the notion of and Perpetual also has a long track record of success in the same space, but we identified as our first sort of foray into this, we actually identified a mineral strategy that we then packaged through an offshore structure, and which has worked exactly the way we predicted it would. You can see its track record there, but more importantly, if you look at the track record on the next page, versus both oil prices and the S&P Energy Index, you can see that it generated a significant alpha versus both. So, same strategy. We're just addressing. If you remember that barrel schematic, we're addressing the top part of the barrel as opposed to the royalty slice of the barrel.
Yeah, we will always be pointing to an operating partner. Perpetual's probably deployed about $1.5 billion within family offices and public operating companies. We've underwritten about $750 million of assets and executable transactions. We set this transaction up. And if you think about what we're doing, this is a lot of small transactions, not one big transaction. And we spend a lot of time working with Perpetual to understand their capability and executing. So ultimately, we are very confident in our ability to deploy the capital and deploy it quickly.
And I think we have time for one more question. See if there's anything online.
I can.
So maybe you can wrap up and talk about you're going to be here for how long, how many days, and how people can meet with you. You're going to be at dinner too.
Yeah, I'll be at dinner tonight. I'll be here tomorrow. I'll be in New York as well, and I believe they've got my contact information in the presentation for us. So look forward to visiting with you all, and enjoyed meeting some of you last night as well. Thanks, Martin.
Fantastic, great.